to change rates. They're already negative interest rates, or whether they would add stimulus to the economy, or whether or not they would stay and hold pat. I think the market was hoping for a bit of stimulus. The Japanese markets have been under pressure lately as the yen continues to strengthen in value. And for Japan, where you have a lot of exports and your currency is strengthening, that becomes very difficult to bring in revenues, especially under their Abenomics plan, which really revolves around a relatively weaker currency. So right here on the platform, I'm looking at this quote, the N225:JP. That just simply stands for the Nikkei index, which is down. That carried into Singapore markets here. So Singapore, the STI is down 22 points, so it's about I apologize, I just switched charts on you guys, so the audio may not have carried through, but we'll make sure to continue here, and I appreciate you guys letting me know what's happening in the chat. But again, the STI down 22 points, that's about 0.8%. So Asia today, not a great, definitely not a great way to look at ending the week here, and a lot of that just basically on the idea that markets were hoping or probably expecting for stimulus out of Japan. That did not happen. The Bank of Japan decided to hold stimulus. Some other things that happened this week, the MSCI index decided not to include the China A shares in its index, which in and of itself could have brought billions of dollars in investments toward China. That did not happen, which is probably a bit of a disappointment. That's been on the plate for about a year. And then you also have, of course, in not too long from now, you have the Bank of England, which is going to release a statement on what they're going to do with stimulus. I think the market is probably expecting it to hold as well. When the question becomes, why are these central banks if the expectation is for them to try to stimulate their economies, why are they not moving forward? And a lot of that has to do with what's happening on June 23rd. June 23rd, Britain will essentially vote, the UK will vote on whether or not they will remain in the EU and the European Union. Every day it seems like I get a new poll that kind of contradicts the previous one. About a month ago, the probability that Britain, or I should say the polls were reflecting that Britain leaving the EU was probably not going to happen. However, as we've gotten closer to the referendum, things have shifted a little bit, and it's definitely very, very close, if not too close to call. And that can definitely shake up the markets a little bit. And you're seeing a little bit of fear in the marketplace, right? You're seeing the 10-year Treasury in the U.S. Relatively low yield as people basically pile in and look for areas of safety. You saw the 10-year bond in Germany, or the German Bund, basically go negative, which means if you can think about it this way, what's happening in Germany is people are actually so concerned about what might happen with Britain potentially leaving the European Union and the volatility that might bring, that they're actually willing to give money to the government to hold for 10 years to give that back, and they'll actually pay money to the government to do that instead of demanding a yield for that. So it's quite an amazing circumstance. It's the first time that the German Bund has actually done this. And that happened earlier this week. So a lot happening that's kind of reflecting investor and trader nervousness or anxiety around this next couple of weeks. So I would encourage you, if you're just coming into the marketplace, great question, Alvin, I will answer in a moment. If you're just coming into the marketplace, and we're going to talk about that here a little bit. Now is really, over this week and next week, we may see a bit of volatility. We may see the markets move a little bit, markets gyrate. A couple of the products that we're going to talk about in a little bit, they're moving around. They're certainly moving around. Volatility is increasing a little bit. And we're going to talk about that. But if this is, again, you're new to the platform, you're new to trading, you're new to investing, whatever the case may be, just be aware that, these next couple of weeks could be a little bit choppy. All right, so that is the markets here in Asia up until this point, and now the European markets are open as well. Let's take a look at how they're doing. This index here that I typed in, the UKX:FTSE, that is basically the FTSE 100, which is down in early trading about 0.5%. You have the DAX in Germany, which is down about 2/3%. The CAC 40 over in France, which is down about 0.5% as well. So low trading here in Europe, which is a bit of follow through from what happened in Asia. You have the Bank of England, another central bank, which is going to give their statement here. I think I mentioned already, but their statement is coming up here soon as well, and we'll see how that impacts the market. Now, how is all of that? And I got a great question from Alvin in the chat room. Where did you get that global indices watch list? Well, Alvin, that's a terrific question. Actually, last week we created this watch list because the great thing about thinkorswim and the platform here is that TD Ameritrade, as we all know, offers access to the U.S. markets, U.S. exchange traded stocks, whether that's U.S. equities or foreign equities that choose to list on the U.S. market, as well as ETFs. Exchange traded funds. You get access to options on ETFs as well as futures, and you can trade futures or commodities such as crude oil, gold, silver, grains, all those types of different products. So you have those things available to you. And while you don't trade international markets, I think it's of course very important to keep an eye on what's happening there because it will impact potentially your position in the U.S. market. So we do offer, Alvin, the ability for you to monitor or type in these particular symbols, which gives you access to at least watch how those markets are performing. So we created this here together, so you're welcome to maybe just take note of the symbols that I typed in here, and I will talk about how to create a watch list here in just a few moments. So great question, Alvin. Everyone here, feel free to type those things in. So the second thing we want to talk about is, now that we know how Asia's shaping up here this morning, and we know how Asia did on the day, and we also know how Europe is shaping up here this morning, let's talk about the U.S. index futures and what the U.S. market is doing so far here before the open. The S&P 500 futures contract is actually indicating a lower open. We're trading at 2,054.25 point. That's down 9.25. In other words, about 0.5%. You have the NASDAQ, which is also down about 0.5%. The Dow Jones Futures, which is down about 0.2%. And the Russell 2000. The Russell 2000 right here, and I'm going to change my chart, so I'll pause for a minute while this loads so you don't lose audio. All right, now what I've done is I've loaded the Russell 2000 into my chart here. Just, again, for those people that aren't as familiar with the Russell, it's essentially an index of small cap companies, about 2,000 companies. So, the Dow Jones is essentially what are called blue chip stocks. In other words, large cap companies within the U.S. The S&P 500 is a mix. You have larger companies as well as smaller cap companies. You have companies across the 10 different sectors. The NASDAQ, it's a more tech-heavy index. So what the Russell gives you the ability to do is kind of monitor the quote-unquote strength of smaller capitalized stocks. Small cap companies don't always perform the same as larger cap companies. And so it's, you get the opportunity within the platform to kind of track that all together. And the reason that's important, folks, when we talk about this month over month, is building a sense of market awareness. How do you have at least a small enough set of symbols so you can look at just a few symbols and really get a really good feel for how the market is performing? without having to look at every single stock out there to really know what's going on. In Singapore, it's probably easy, right? We just look at the SGI, and 70% of the trading volume occurs on the SGI. Whereas in the U.S. markets, it's definitely a little bit more liquid, a little bit more robust, a little bit more complex, and therefore we need to know what instruments to be looking at to give ourselves that good gauging. And that's why we're following along this watch list that I have here. These aren't recommendations by any stretch of the imagination, but what they do allow you to do on your end, if you want to create a watch list with these particular symbols that are a good starting point for market awareness. The Russell 2000 is down about 2/3%, and that takes us folks to the VIX, the VIX, the Volatility Index, and this is becoming even more and more important, weeks over week, and I'll explain why. One, I'm going to explain what the volatility index is, and then I want to explain why it's becoming more and more important and more relevant. So first and foremost, the volatility index, or the VIX, it's also known as a fear gauge in the market. So really what it is an index that tracks the forecasted or future volatility that's being priced into the market. What do I mean by forecasted or future volatility? Well, if the market, let's say, and when I say the market, I'm referring to the S&P 500. If the market is at 2,000, okay, then the VIX is at 10, just to use very simple numbers. What that's saying is that the market is expecting about a 10% move over the next year. Okay, so the VIX is expressing an annualized percentage number. So if that number is 10, that means the market is really pricing in about a 10% move up or down. So if the S&P 500 was at 2,000, 10% of 2,000 is 200. So that means you and I as traders, we would know using the VIX that the market is really pricing or gauging a 200-point move to the upside or a 200-point move to the downside. And therefore, my expectation of the trading range over the next year should be 1,800 on the low side to 2,200 on the upside. Now, if that number went from 10, let's say to 20, let's imagine now in a hypothetical scenario, the VIX has gone from a value of 10 to a value of 20. What does that mean for practical purposes? Well, what that actually means is now instead of our range being 1,800 to 2,200, our range is now 1,600 to 2,400. And the way that we do that is if the VIX is 20, that means we're forecasting a 20% move of 2,000 up or down. 20% of 2,000 is 420. So we use the VIX to give ourselves this kind of relative gauge for how the market is forecasting the future movement of the market, the future volatility of the marketplace. So using those figures here, we actually see the VIX is at 21.13. It's up 99 cents here so far, basically at 5%. So now we know, and I'm switching symbols here so you guys can see this on the chart. You can see this huge move over the last couple of sessions. We were basically down around a 14 handle in the VIX, and we've moved up. We actually touched 22, but we're now settled around 21.14. And what that means, folks, is people in the marketplace over the last 2 to 3 sessions, I should say 3 or 4 trading sessions, became a little bit more nervous, a little bit more fearful about the potential volatility of gyrations in the marketplace. And what they're doing is effectively buying insurance or buying premium, buying puts in the S&P 500 and different types of things like that, which hedge their portfolio. Large professional money managers, retail traders like you and I. One way you can hedge is to buy insurance or premium. And we talk about those different types of strategies, typically on the intermediate to advanced classes on Tuesday. But if you think about it, now people are getting a bit more nervous. Why are they getting nervous? Well, because there was a lot of uncertainties here, not only this week, but next week. There was the Fed meeting. There is the Bank of Japan meeting. So another central bank. You have the ECB, I always want to say ECB. It's the Bank of England meeting. You have the Brexit referendum, or the referendum next week. So all of these kind of events together over basically a 7 to 10 day period kind of create a lot of uncertainty for the markets. And when it does that, people get a little bit more fearful about what the market can do. And they start to buy protection. They start to buy insurance. And the VIX, folks, is our clue into when that's happening, right? If we didn't see any movement in the VIX, right? If we didn't see any movement in the VIX, and we just watched the S&P 500, we couldn't necessarily get that context. But if we're able to utilize this particular index and view it on a regular basis and start to get a feel for it, then we're able to kind of see or put together a bit more context in the story behind the market. So, me personally, I think this is a very important index to watch. It's something that I reference it's something I reference every single trading day, and it's something that you'll hear me bring up week over week over week. I think it is important that we cover this here together. If you have questions on that particular index or instrument, feel free to type them in. But for now, we're going to move on and start to talk about a few individual products. We got about 5 minutes here left in our market wrap, and then we're going to dive into learning about specifics in the platform. So I'm going to move on, and I'm going to change my symbol here to /CL. And what /CL is light sweet crude oil, WTI variety. In other words, it's the U.S. crude oil versus Brent crude. So /CL or crude oil now trading at 47 handles, 47.29, down 72 cents. That's about 1.5%. And you can see what's happened here recently. You're kind of trading in this range from $26 since February. View the channel that we had been trading in. You can see it's starting to test the bottom end of that channel here, which may or may not be surprising for some. I think as crude oil approached 52.5, it was doing so on a couple of different things. Let's just keep in mind what's happening. What's the story behind crude oil and the move here lately? Well, first and foremost, about 3% of global supply, or expected global supply, was taken offline. And it was taken offline by a variety of factors. All right, you had Canada, wildfires across Canada that took out significant amounts of oil sands production, about 1 million barrels per day. And then you also had, let's call it unrest throughout Africa and Nigeria and a few other places. So all of that's combined to probably take us out maybe 3%, take out 3% of global supply. And you kind of saw, even though that the dollar was strengthening, and typically the dollar and crude oil or dollar-denominated commodities like crude oil, so the crude oil is priced in U.S. dollars, right? So as the dollar gets stronger, theoretically, if all else is equal, you would see the crude oil price decrease because it theoretically takes less dollars to buy that same barrel of crude oil because the dollar value is strengthened. And then vice versa, if the dollar weakens, it theoretically takes more dollars to buy that barrel of crude oil. And so we kind of saw an interesting relationship where even at a period where the dollar is actually strengthening, crude oil is still rising because of those supply disruptions. And what you're seeing here recently is probably a couple of things here. You're actually seeing the opposite of that. You're seeing the dollar is now weakening, but even though the dollar is weakening, some of those supply disruptions, the concern over supply disruptions, is basically maybe 52.5, we started to maybe outrun the short-term move to the upside of crude oil. You saw a lot of those factors come in, and now crude oil is kind of cooling off, so to speak, from that 52.5 level. We're now at 47.25. I think it's going to be interesting here at this 47 level. And another thing, I know this is typically a basic demo. I know we're getting a little bit in the weeds, but a lot of people come to me every week and they say, look, we love the market wrap portion of the segment. We've got to keep that in. We love the context that gives us before we dive into the ins, the outs, the different clicks and buttons available on the platform. It's always important, I think, to keep that market complex. So that's crude oil, folks. And the last thing we'll probably, the next two products we want to talk about here before we move into the specifics of the content we wanted to cover on the platform tonight is, the second to last here is going to be crude oil. Sorry, gold. Where it says GC, that's COMEX gold in the platform with the August expiry, is now moved above 1,300. It moved above 1,300 in this session. It's now trading at 1,309 for an ounce, up 20.70, $20 here today. That's 1 2/3%, or right about. And gold has a very, very interesting kind of V-shaped move. If you could take a look at really what's happened here, 1,300, the market moved off swiftly in the month of May from 1,300 all the way down to 1,200, basically sealed off 100 points throughout the month of May before moving up from 1,220 all the way again up to 1,320. And a couple of the factors, let's keep in mind, what is gold, folks? What is gold? Well, a lot of times it's a quality instrument, right? It's currency. Sometimes it doesn't necessarily, as we all know, fiat currencies don't necessarily have backing. So when people are a bit nervous about currency, or they're a bit nervous about equities, they're a bit nervous about return on their dollars or safety on their dollars, gold tends to be an area where investors might put their money who are looking for safety. So as you've seen basically over the last 10 trading sessions or so, the market has been looking for areas of safety among uncertainty, right? And you have all these central banks getting ready to potentially change their interest rates. Then you have the Britain, which might potentially exit the European Union, which then changes the composition of the euro, and will definitely have impacts on the pound. You have all of these factors coming into play where a lot of investors and traders are saying, you know what, it's going to be really hard to judge what's going to happen with these currencies over the next couple of weeks. So instead of maybe look at some of those currency moves, let me look at two things. And what are those two things? Those two things are gold. Well, I should say three things. Those things are gold. Those things are basically bonds of some sort, right? So now we see bonds, investors have higher demand for bonds, so yields decrease. And so that's what we've basically been seeing. And we've also seen an increase in volatility, so people are buying protection at the same time because of their portfolio. So we've seen all three of those things happen, and this is a good example. So I think the question is, after June 23rd, if we start to see some unwinding of this particular trade, is this really a flight to quality? And especially if Britain votes to stay in the European Union, are people still fearful? How do they unwind some of these trades? Do they move back out of bonds? Are risk assets going back on the table? Do we start to see, is that going to be a plus for European equities as well as global market equities? If that risk that in some ways the market is now discounting, if that risk just completely dissipates, or maybe we've all that discount has been priced in, maybe that comes off the table and equity prices are going to lift a little bit, gold will come off the table, bond yields will increase. If that doesn't happen though, if Britain does choose to basically leave the European Union, I do think we could see equity prices leg down further. We could see gold increase further, and I think we could see volatility increase even more than this now. So that's, hopefully, I wanted to take the opportunity to really cover a few different things. And hopefully we did that, and I know there's a lot of questions that we saw on our desk for the last couple of days about the Brexit referendum, what it is, what it means. There is going to be, I'll kind of try to sum it up.